We do believe that the emergence of these alternative property types is going to accelerate in the future, and that many next gen leaders, are going to be a big part of that, but also some of the fundamentals that we're seeing within data centers and cell towers and life sciences and, senior living, just with overall demographics are going to be really, really critical to the overall industry and growth of commercial real estate.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. Today, I'll be speaking with Mark Wojteczko, Deloitte's National Real Estate Fund's co-leader. Mark is here to talk about findings from a recent Deloitte predictions report into how recent market forces and new leadership could impact well-established strategies when it comes to commercial real estate investing. So, Mark, thanks for joining the podcast today.
Thanks, Sarah. It's great to be here.
So, Mark, you say in the report that a shift to alternative property types is already underway, and that's definitely an established theme in the REIT sector. Can you talk about how the numbers reflect that trend in recent years?
For sure. And maybe taking a step back, when we think about commercial real estate, for many decades, this would probably primarily be a focus on the core four, being retail, residential, office, and industrial as the dominant property types. Fast forward to 2025, and as we sit here today, it's clear that alternative property types are having a significant impact on commercial real estate. When we think about alternative property types, we're talking about data centers, cell towers, life sciences, self-storage, single-family homes, senior housing, student housing, right, amongst other different property types. And the population of these alternative types has grown at about a 10% compound annual growth rate since the year 2000. So going from about $67 billion to $600 billion as we sit here today as an overall asset class. Taking that a step further and trying to understand why that's the case is really looking at some of the performance of these alternative property types, which have generally outperformed traditional properties over the past decade with about 11 to 12% annualized returns in comparison to about 6% for traditional property types. So all of this really driving this growth that we've seen across some of these alternatives.
And what could you point to as some of the underlying trends supporting this development of alternative asset classes?
Yeah, if I take a step back, I think there's probably three primary structural indicators that we think of driving these alternative asset classes. Those being advances in technology, some of the demographic shifts that we're sitting as we sit here today, and then overall housing affordability. So maybe first starting with the advances in technology, and probably no real surprise here. We can't go a day without reading about artificial intelligence and the impact that's having on our overall economy and everything that we're doing, as an overall kind of country and the impact that it has. What are 5G innovations? And all of this and all of these advances really spurring the investor interest in both data centers and cell towers, which have become real significant asset classes within the commercial real estate industry. If we think about demographic shifts in the US, those that are 75 and older, we believe that group will grow to be greater than 40 million people by the time we get to 2040. So people are living longer as the baby boomer generation accelerates here. And some of this growth and change really underpins an expected demand for asset classes such as senior housing facilities, or the focus that we see on life science and life science properties, and all of that really driven by our population. And then lastly, I think we would need to talk about housing affordability. And if you think about where interest rates were from 2010 through 2020, I mean, a 30-year mortgage was typically between 3 and 4%. And so fast forward to today, and with the rising and some of the instability that we've seen in these interest rates, there are really two issues that we're seeing. One, people that aren't moving, that have locked in some of these lower interest rates. And then two, people that are looking to move, just finding that some of this housing is more expensive, and the cost of capital and these interest rates really driving some of the issues there. This bodes really well for some of the alternative asset classes such as storage, single family homes, and what we're seeing just in terms of the housing affordability issues that we're seeing across the country.
And how would you compare the extent to which listed and private real estate have shown interest in these alternative property types?
Yeah, I think it's certainly there. And we're seeing an increase in an acceleration on the private real estate. But it's clear as we sit here today, it's nowhere near as mature as what we see within public REITs. I think within the public listed REIT market here in the US, these alternative property types make up approximately 55 to 60% of the overall market capitalization of these companies. And if you were to take that a step further and look at the top 10, you're going to see significant representation from these alternative property types, whether it's data centers or cell towers or healthcare REITs. And so clearly defined and well established on the public side. The private side, there is growth. However, it has been at a slower rate. If we were to look at some of the benchmarks that exist today, like the NCREIF Open-End Diversified Core Equity Index, which is what we call the Odyssey Index, consists of about 25 diversified core property funds. That core four, the retail, residential, industrial, and office, still makes up over 90% of the total value that we've seen. But there have been some recent shifts, particularly with like self-storage and healthcare properties over the recent years. And so there is some growth there. There's also an acknowledgement within the NCREIF MPI data, which provides quarterly information on income return and appreciation returns that just last year in 2024 expanded the database and the survey results that they have to include alternative asset classes such as single family, data centers, and life sciences. So it's clear that it's growing on the private side. It's at a more muted pace than what we've seen in the public maturity that we have within the public market space. But certainly as investors are looking for yield and new ways to unlock value, we've seen many more of our private real estate clients with an interest in these alternative property types.
And Mark, your predictions report also considers an anticipated wave of industry leader retirements over the next decade and what that might mean for a shift to alternative property types. Can you share what you're thinking in that area?
So I find this to be quite a bit interesting, and it's something that within Deloitte we've coined as the retirement cliff, specifically when we're thinking about commercial real estate. So through some of the analysis and the surveys that we've done with the U.S. Bureau of Labor Statistics, we've identified that commercial real estate actually has the oldest median age of any commercial industry in the U.S. At approximately 49 years old as we sat in 2024. So this was ahead of insurance and banking, which is around 44 years old, investments, which is around 43 years old, and just an interesting data set as we sat back and reflected on this. We expect that if some of these demographics continue as they've been going, that 40% of the commercial real estate industry may reach the age of retirement by the year 2034. With a significant portion, greater than 50% of those retirees actually being in C-suite titles. And so succession planning and trying to figure out the new leaders within these firms is going to be really important. We considered all of this data in our 2025 Commercial Real Estate Outlook Survey, which we do on an annual basis, where we are going out and surveying many C-suite executives and their direct reports across the commercial real estate industry, across a variety of questions and different topics. One that we found to be really interesting is that respondents that were aged 40 or younger actually selected alternative property types nearly 10% more often than some of their counterparts. So we believe that the appetite for some of these younger executives to really continue to focus on the alternative property types as an investable universe is significant and something that we're certainly monitoring here in future years.
So, what are some important considerations that owners and investors should keep in mind when turning to emerging sectors?
Yeah, so there's a variety of considerations that we think are really important here, especially for those companies or funds that are expanding into a new investable universe. One is focusing on active management and experienced partnerships. So really making sure that investors are aware of what are the different operational, regulatory, and industry-specific nuances that you may see across these different property types. Leveraging partnerships such as joint ventures could really be a benefit to some of these investors that could enable them, these less experienced partners with capital that is available to deploy to collaborate and really work with experts and operators with the specialized knowledge that you may need for some of these property types that aren't part of the traditional four that many of these investors have significant experience with. So I think really focusing on the operational management and leveraging partnerships where available will be really key here. I think a second thing is just understanding what are regional supply and demand gaps. When you think about what are the differences you could see on a region by region basis, they could be significant. And some of it could be simply supply and demand and understanding if a certain asset type has a dominant share in a certain location versus other assets and the supply and demand ratio that you may see there. Also, understanding some of the regulatory hurdles that you could see in different regions. We've talked a lot about data centers and cell towers, and clearly those are really important property types as we sit here today. But when you think about what powers those and the energy availability and energy costs, that can vary from location to location. So, really important aspect of considerations here when you're looking to turn to some of these emerging property sectors. From there, you need to think about your investors, your respective funds, and making sure that you're aligning with any sort of broader strategic goals that you may have. These sectors are going to offer a difference in yield. And if you're a core diversified property fund and you make some investments in data centers, which can be very expensive to develop, have a high cost of capital, you may have capital that's tied up in the development of these assets that could have an impact on dividend yield or other yield that your investors may be expecting. And so really making sure that you're aligning with the broader strategic goals that you have and really communicating those clearly. And then I think lastly is just really balancing these alternative types with core property types. I think one of the beauty and one of the reasons that real estate always has been such a popular investment is the diversification that it provides and some of the barriers that it has against inflation in other areas, and making sure that we think of alternatives just as another manner by which to really diversify our portfolios while still managing those core asset types that you have and overall investor expectations. So I think all of these different aspects are really going to be important for the owners and investors to think about as they try to start investing in some of these alternative property types.
And given what you were saying about this new cohort of leaders, as you look further out, how long do you think it could take for these emerging property sectors to become much more mainstream?
I mentioned earlier some of the statistics just on how quickly this alternative asset class has grown. And really, from a public REIT standpoint, that 55 to 60% of market cap as we sit here today is really quite pertinent and quite impactful. We believe through some of the analysis that we've done that if these property types continue to grow, and that growth may be at a 15% compound annual growth rate to account for potentially over 70% of industrial portfolio values by the time we get to 2034, 2035, which is a significant increase from the 40% that it is today as we think about both private and public in the overall landscape. Now, clearly, this won't happen overnight. There's a lot of different things for investors to take into consideration. There's still fundamental challenges that are facing the industry for both alternatives and core properties, whether it's the elevated interest rates, vacancies, and other structural headwinds that exist today. I think when we think about the core four, particularly around office properties and some of the capital that may be locked up with some of those older asset classes, and finding ways to redeploy that towards the emerging assets will be really important. But based on the analysis that we've done, some of the information with the aging of the executives within the commercial real estate industry and the views of some of these new younger leaders, we do believe that the emergence of these alternative property types is going to accelerate in the future, and that many next-gen leaders are going to be a big part of that, but also some of the fundamentals that we're seeing within data centers and cell towers and life sciences and senior living, just with overall demographics, are going to be really critical to the overall industry and growth of commercial real estate.
Sounds like the landscape's really going to be changing in the coming years.
Yeah, we think so, right? It's a really interesting time for commercial real estate as we sit here today. I think if you rewind back to August 2024, expectations were really high for 2025 to be a true turning point for the industry. Values hopefully had bottomed out. Fundamentals have been and continue to be strong, but interest rates were really the big question mark that we were seeing. I've listened to a few of your recent podcasts, and it's clear we're hearing some common themes around uncertainty as we sit here today. And what is the impact of tariffs? When will interest rates stabilize? And what will all of this mean on a go-forward basis? But I think it's really critical that investors and others think about these alternative asset classes and what can they provide to you and your portfolio from an overall diversification standpoint, but really some of the yield and the investment returns that we're seeing from these types, just given the change in demographics and overall trends we're seeing within the U.S.
Mark, this has been really informative. Anything that we haven't covered that you'd like to touch on?
As I alluded to, it's an interesting time right here. I think we're all very optimistic that we're going to see some continued growth here in the future, but we're going to need to see things like interest rates stabilize here in the future. The core fundamentals are strong. And hopefully this is a new period of growth for commercial real estate, both within the traditional core, but also in this expanding group of alternative property types.
Excellent. Mark, thanks so much for your time today.
Thank you, Sarah. It was a pleasure to be here. I really appreciate it.
And if you enjoyed this episode of the REIT Report, please subscribe or leave a review on your favorite podcast platform.